The U.S. economy has been buoyed by robust consumer spending, despite facing significant headwinds such as high inflation and elevated borrowing costs. This consumer resilience has played a critical role in averting a recession that many analysts predicted would follow the pandemic. However, recent signs indicate that this spending power may be waning, raising concerns about the sustainability of economic growth. The potential for an economic downturn has been exacerbated by the uncertainty surrounding the impact of tariffs introduced during President Donald Trump's administration. Although the immediate threat of recession has been mitigated by the pause on the highest levies, the strain on consumers is becoming more apparent as inflation continues to erode purchasing power, and borrowing remains expensive due to high interest rates. This economic environment poses a challenge for policymakers and businesses alike, as consumer spending accounts for a significant portion of economic activity. Should consumer spending falter, it could lead to a slowdown in economic growth, affecting market sentiment and potentially leading to adjustments in monetary policy by the Federal Reserve. Investors and businesses will need to closely monitor consumer behavior and economic indicators to navigate the evolving economic landscape effectively.
U.S. stock markets experienced a downturn on Tuesday, with the S&P 500 snapping a six-day winning streak and the Dow Jones Industrial Average and Nasdaq Composite each declining by nearly 0.3% to 0.4%. This pullback follows a recent rally driven by optimism over a temporary easing in U.S.-China trade tensions and cooling inflation. However, skepticism is growing among investors and analysts, including J.P. Morgan's CEO Jamie Dimon, about the sustainability of this optimism without concrete trade agreements. Despite a 90-day tariff pause announced by President Trump, concerns persist regarding the potential economic impact of existing tariffs, as highlighted by St. Louis Fed President Alberto Musalem. In corporate news, Warby Parker's stock surged by approximately 18% following the announcement of a collaboration with Google to develop eye-powered smart glasses. This partnership, which involves Google's commitment of up to $150 million, underscores the increasing convergence of technology and eyewear. Meanwhile, Home Depot's stock fell around 1% after reporting mixed earnings, with profits falling short despite revenues surpassing forecasts. The retail giant maintained its guidance despite concerns over tariff impacts, particularly after Walmart's warning about potential price hikes. Additionally, long-term Treasury yields saw an uptick as investors reassessed fiscal risks following Moody's downgrade of U.S. credit, which has reignited concerns over the nation's fiscal health and inflation pressures.
Warby Parker Inc., NYSE, WRBY, saw its stock surge by 15.9% to $20.38 following the announcement of a strategic partnership with Google. The collaboration involves up to $150 million in support from Google, divided equally between an equity investment and funds for product development and commercialization. This partnership aims to develop eye-powered smart glasses that integrate Warby Parker's eyewear design with Google's technology and Android XR platform. The first generation of these innovative glasses, available in both prescription and non-prescription lenses, is anticipated to launch after 2025. The significance of this partnership lies in its potential to position Warby Parker at the forefront of the smart eyewear market, leveraging Google's technological prowess. This move aligns with the growing trend of integrating artificial intelligence into everyday consumer products, potentially enhancing user experiences through advanced functionalities. For investors, this development could indicate a promising growth trajectory for Warby Parker, as evidenced by the immediate positive reaction in its stock price. The collaboration underscores a broader trend of tech-driven innovation in traditional consumer sectors, which could influence market sentiment and investment strategies.
Tesla CEO Elon Musk announced that the company's sales are recovering well after a temporary slump, attributed to backlash from his political affiliations, particularly his support for former President Donald Trump. Speaking at the 2025 Qatar Economic Forum, Musk noted that Tesla's market capitalization has once again surpassed the $1 trillion mark, suggesting a positive market response. Despite a decline in sales in Europe, Musk emphasized that Tesla's performance remains robust in other regions, reflecting resilience in the company's global operations. In a strategic shift, Musk also declared his intention to reduce political spending, which had previously amounted to hundreds of millions of dollars, largely in support of Trump's campaigns. This move could signal a cooling of the previously close relationship between Musk and Trump, as Musk steps back from his role as an informal advisor in the administration. The decision comes amid concerns about the impact of Musk's political activities on Tesla's brand, which has faced protests and vandalism at dealerships. By refocusing on Tesla's core business, Musk aims to mitigate any negative effects on the company's reputation and sustain its market position.
BlackRock Inc., the world's largest asset manager, reaffirms the centrality of U.S. assets in global portfolios despite Moody's recent downgrade of U.S. credit and synchronized declines in stocks, treasuries, and the dollar. Jean Boyven, head of the BlackRock Investment Institute, notes that while the downgrade highlights U.S. fiscal sustainability challenges, it does not alter BlackRock's core allocation strategy. The firm emphasizes the structural importance of U.S. markets, driven by the dominance of U.S. companies, particularly in technology and artificial intelligence sectors. Despite recent market volatility, the S&P 500 has rebounded 28% since April, supporting BlackRock's overweight position on U.S. stocks for the next 6 to 12 months. BlackRock acknowledges investor concerns about persistent inflation and fiscal deficits, noting that the term premium on long-term U.S. Treasuries remains low despite these risks. The firm argues that investors might demand a higher term premium due to ongoing fiscal deficits and inflation. Despite these challenges, historical patterns suggest that factors like dollar weakness and policy uncertainty have not led to structural exits from U.S. assets. BlackRock remains bullish on inflation-linked bonds and sees opportunities in private markets, particularly in infrastructure assets. The asset manager maintains that U.S. assets are vital to global capital allocation and should remain a cornerstone for investors.
At the Qatar Economic Forum 2025, Qatar's Minister of State for Energy Affairs and CEO of Qatar Energy, Saad Sharida Al-Kaabi, emphasized the necessity of maintaining a fair oil price, suggesting a range of $70 to $80 per barrel to ensure sustained production and the development of additional reserves. This pricing is deemed crucial to prevent supply shortages and support global energy needs, especially as the world population is expected to grow significantly in the coming decades. Al-Kaabi's comments underscore the importance of continued investment in energy projects to meet the increasing demand for electricity and power, particularly in regions lacking basic access. The forum also highlighted Qatar Energy's strategic focus on expanding its gas exploration activities globally. Al-Kaabi noted the company's success in securing exploration rights and its ongoing efforts to explore new blocks, projecting optimism for future growth despite the inherent time-consuming nature of these endeavors. Additionally, Al-Kaabi discussed the recent Qatari-U.S. energy partnerships, including the Golden Pass LNG export project, which signifies strengthening bilateral ties and collaborative ventures in the energy sector. These developments are poised to enhance Qatar Energy's trading capabilities, with plans to significantly increase LNG production and expand its fleet, thereby bolstering the company's position in the global energy market.
Vaccine stocks are experiencing an upswing following the release of documents by the U.S. Food and Drug Administration, FDA, which indicated that its advisors are set to meet to discuss updates for the COVID-19 vaccines targeting the LP.8.1 subvariant for the 2025-2026 vaccination cycle. This subvariant, originating from the previously prevalent JN.1 variant, now makes up approximately 70% of COVID-19 cases in the U.S., as per recent CDC data, and is also spreading globally. The FDA's consideration of updating the vaccine strain reflects the virus's ongoing mutation, with other variants like LF.7 and XFG also under observation. The proposed update could significantly impact the vaccine market, particularly for companies like Moderna and Pfizer-BioNTech, which produce mRNA vaccines, and Novavax, which offers a protein-based alternative. In a related announcement, the FDA stated that new clinical trials would be mandatory for annual COVID-19 boosters for individuals under 65, thus restricting the upcoming fall vaccine rollout to older adults and those at increased risk. This development could influence vaccine demand and production strategies. The stock market reacted positively to these announcements, with Moderna shares rising by 5.70% to $27.90, and BioNTech shares increasing by 3.63% to $101.36. This uptick reflects investor optimism regarding the potential for increased vaccine sales and the strategic positioning of these companies in addressing the evolving pandemic landscape.
Palo Alto Networks CEO Nikesh Arora emphasized the transformative impact of artificial intelligence (AI) on the cybersecurity sector in a recent CNBC interview. As businesses increasingly integrate AI into their operations, Arora highlighted the critical need for robust security measures to protect these systems, urging companies to deploy AI bravely. He noted the significant investment by tech giants in data centers, projected to exceed $300 billion this year, underscoring the urgency for businesses to secure their technological infrastructure to remain competitive. Despite reporting better than expected earnings and revenue, Palo Alto Networks experienced a 3.7% dip in share price in extended trading, attributed to lower than expected gross margins and market uncertainties, including heightened tariffs. Aurora described the quarter as challenging, but commended the company's performance under these conditions. This highlights the broader market volatility and the ongoing challenges companies face in navigating the evolving landscape of AI and cybersecurity.
Beeline Holdings, Inc., Nasdaq, BLNE, a fintech-focused mortgage and title company, has reported its first quarter results for 2025, marking its debut as a public company. The company showcased significant growth driven by its AI-powered platform, with loan originations increasing by 38% year-over-year, vastly outpacing the industry average growth of approximately 9%. This surge in originations was attributed to the company's iMortgage agent Bob 2.0, which significantly boosted lead conversion and application volumes. Additionally, Beeline's workflow engine, Hive and Task, has halved traditional closing timelines to 14 to 21 days, emphasizing the efficiency of its proprietary automation strategy. Despite the promising growth metrics, Beeline reported an operating loss of $4.9 million and a net loss of $6.9 million for the quarter, aligning with its growth investment strategy. Total net revenues reached $1.8 million, largely driven by mortgage and title operations. The company is actively working to reduce its debt, having decreased it by $2 million, and is focused on launching a new interest rate neutral equity product in the third quarter. This product aims to facilitate real estate transactions beyond traditional mortgage channels, potentially expanding market participation. Beeline remains committed to advancing its SaaS initiatives and strategic partnerships to enhance its market position and customer experience, while striving towards sustainable profitability.
Home Depot has announced that it does not anticipate raising prices due to tariffs, attributing this stability to its diversified supply chain strategy. The company's executive vice president of merchandising, Billy Bastick, emphasized that Home Depot suppliers have shifted their sourcing across several countries, ensuring no single country, apart from the U.S., will account for more than 10% of its purchases in the coming year. This approach contrasts with other major companies like Walmart and Subaru, which have signaled impending price hikes due to the ongoing trade tensions initiated by the U.S. government. President Donald Trump's tariff policies have been criticized for potentially exacerbating inflation, as many economists argue that the costs will ultimately fall on consumers. Despite the challenging economic landscape, Home Depot's financial performance in the first quarter demonstrated resilience. The company reported a revenue increase to $39.86 billion, surpassing analysts' expectations, with customer transactions rising by 2.1%. However, same-store sales showed a slight decline, reflecting broader market challenges, including a sluggish housing market impacted by high mortgage rates and economic uncertainty. Home Depot's commitment to maintaining its sales growth projections at 2.8% underscores its strategic focus on smaller home improvement projects, which have seen continued customer engagement despite the broader market headwinds. This performance highlights Home Depot's strategic agility in navigating complex trade dynamics and consumer behavior shifts.